Hey guys, my portfolio has been doing really good lately, but enough about me. What we really want to know is how are the high yield dividend warriors doing? I hear they continue to reach all-time new lows. Yes, it's hard to believe, but they're still finding a way to keep lowering and lowering that bar. What was once touted as a can't-miss, recession-proof, dividends forever, $83,000 a month strategy is now a loss of a significant part of their hard-earned money that they will never get back. Remember, these warriors legitimately thought they would get $83,000 a month in passive income for the rest of their life. For the rest of their life! And their Magic Beans investment, Misty, continues to be a good source. Yeah, a good source of keeping warm this winter as it continues to burn money. Misty is down 45% since December. This is a foundational fund for these warriors in their quote-unquote retirement. Can you imagine losing that much money in 2 months while the market is still experiencing a bull run? I just want to emphasize how hard it is to do this poorly in the stock market during good times. Like, this is like professional levels of losing. Let's go over some of the key reasons why the warriors have failed so badly and what good investors do instead. After all, we can learn a lot from the warriors as their investing sins teach us exactly what not to do. Number 1, chase yield, aka the Dumb and Dumber strategy. I have heard on multiple occasions that these warriors say on their live streams and Reddit posts, all you have to do to be a good investor is just filter to the highest dividend yield and buy. Don't ask any questions, just buy. This is the dumbest thing you could possibly do. Well, this is number 1 on a long list, so the warriors will continue to do dumb things. Chasing yield is like picking a hospital based on who has the loudest ambulance siren. Dividends need to be sustainable. When you see a 150% dividend yield, when the standard S&P 500 return every year is just 7 to 10%, you really have to question, geez, is 150% yield safe? These warriors just see that big number and they start to feel all good in their pants, and that's all they need. Remember, companies have zero obligation to pay you a dividend. A dividend is never guaranteed. We have companies all the time that have paid dividends for decades that just stopped paying dividends, like, for example, Walgreens, or they have cut their dividend after decades, like 3M recently. Income ETFs are no different. If the fund manager does a lot of poor trades, that dividend that you think you're getting is just getting your own money back and calling it a dividend. Y'all are getting hoodwinked by these fund managers. This is a dividend fugazi. The fund managers are fleeing to Cuba with your money. Thanks for making them rich, because you keep claiming you don't care about high expense ratios. Because you guys just keep buying it. I'm glad these warriors finally got clapped. It's been long overdue. They've been so arrogant. Maybe, just maybe they'll learn some lessons. Nah, I doubt it. Number 2, going all in on one position. You see, many of these warriors, they go all in on one position, thinking they just need one investment to grow rich. Rich people often are so well diversified across several investments. They do not do dumb things like be exposed to significant risk by putting all their money in virtual tokens. The hot companies, they come and go. They actually come and go quite fast. Here's a list of the top companies in the year 2000. How many of these companies are still the big daddy just 25 years later? 25 years is not even as much as an average investor's time frame. Like, if you're 22, you potentially have 40, 50 years of investing where you can grow your money. So 25 years is absolutely nothing. There's a chance of losing 100% of your money with single stocks. People do not realize how risky investing in individual stocks are. Companies go out of business all the time. There's also things that you can never predict, such as company scandals. The company might be doing fraud. The industry goes defunct. Who's using those Kodak cameras anymore? This is why ETFs are actually an amazing alternative, especially the ones that have the metrics to be filtering out to only include the best profitable companies. Going all in on Misty is emotional investing. Actually, it's not even investing. It's just gambling. Having all your eggs in one basket can lead to increased stress and anxiety, leading to poor investment decisions. Some of you think that you're fighting the dragon, but no potions, no spells are going to help you here. Okay, but Cody, it's an income ETF, so I'm diversified. But oh, no, here's where you're wrong. Number 3, pretending NAV erosion isn't real. The high yield dividend warriors, the original NAV erosion deniers. According to them, economics is not real. NAV represents the total value of an ETF's assets minus its liabilities divided by the number of shares outstanding. And I will explain to you why NAV is and will always be important. If you see the NAV eroding or going down, that basically means your money is declining. How any investor can see their investment go down and down every single month and possibly think, geez, this is a good thing. They need to have their brain examined and studied. I also have some volcano insurance to sell you. Also, the cow pound effect is dividends will also go down. This is because income ETFs use their assets to produce the dividends via options trading. Thus, if there's less assets to do options trading with, there's going to be less dividends to pay out. Now, as the NAV drops, the income yield might also decrease, affecting your cash flow. It's also an indication of poor management. Where else do you get to see live, minute-by-minute analysis of how someone else is handling your money? The stock market literally has this on full display for us. Yet these imbeciles think that if they see their money going down, that this is somehow a good thing and a chance to buy even more shares. Now, some example of income ETFs that have clear NAV erosion include Tesla, Alti, Triple QY, Clip. Now, all of these also share not only NAV erosion, but that these were all also very popular at one point among the high yield dividend warriors. They really thought these ETFs would help them grow rich. They got shiny object syndrome and they jumped ship to the next get rich quick scheme. And when the margin man came knocking, they just said, oh, we're actually not going to pay. Yeah, good luck with that. If only they didn't have your social security number, your address, your emergency contacts. Oh, you done did it this time. Number 4, thinking this is the new way of investing. You know when Misty was having its run up and it was giving high dividends and everything was good? Many of these high yield dividend warriors, you see, they would leave daily comments on my videos about how I was such an idiot with the old way of investing and how I needed to get with the modern times and adopt the new way of investing. Oh, and by the way, these warriors, they've been awfully quiet in my comments lately. I wonder why. Apparently, the Warren Buffetts and the Peter Lynches, they were old news. Their common themes of investing are outdated. Here's some things that you should no longer do, according to them. Invest in only what you don't understand. No need to have a circle of competence. Just buy whatever the latest hot stock is. Just listen to some billionaire think they actually care about you. Invest in digital tokens and think they will always go up forever. My personal favorite is, oh, these were designed to always go up forever. There's actually no way they can go down. There's absolutely no risks. And there's no need to focus on quality companies anymore. There's no need to look for economic moats, no predictable earnings. Just buy companies that are all based on hype. If you haven't proven it yet, I am impressed. I want it now. Unprofitable companies? I smell opportunity. Opportunity to lose money. This apparent new way of thinking emphasizes belief. Let me be real clear with you guys. Belief has no impact on share price. The more and more you wish and think about a stock going up, that does not matter. The stock market doesn't care about what you believe in. I wish the stock price would go up. You see? It doesn't work. The only thing that matters in the long run is how much money are you bringing in tomorrow. The stock market only believes in hype for so long until it comes crashing down. There is no new way of thinking because the old way of investing will never get outdated. The principles of investing, they will never change. Buy high quality companies. Don't try to time the market. Avoid high fees. Keep the emotions out of investing. Diversification is key, and invest in the long run because there is no get rich quick scheme. There is one thing that will change though, and that is the sucker. The sucker that is born every minute. The sucker that ignored all my previous videos of warning after warning. The warriors are absolutely panicking. They are selling the same funds that just a few weeks ago they said they would hold on to forever because there was no risk. Yet it couldn't even survive a small blimp without getting margin called. Because yes, of course, these Nimrods had to cow pound their stupidity by taking out loans. So their losses were even more amplified. They lost even more money by investing with money they did not have. They then continue to sit in their echo chamber, listening to only good news, banning anybody who dares talk some sense into them. I do not feel sympathetic for these high yield dividend warriors. They need to learn that if you play stupid games, you will win stupid prizes. Check out my full $230,000 portfolio. You see, my portfolio doesn't just keep going down and down. Check it out in the Patreon link below. I can't promise you I know how to fight the dragons, but slaying these warriors is just too easy. Join the Discord for some more great chats. My videos are always found in podcast form under the Collect Cash podcast name.
I'm not paying it. I don't care. Because let's roll the dice and see